Good afternoon, everyone. Welcome along to today's landmark webinar. My name is Sam Peacock. For those of you that don't know me, I'm the Business Development Manager here for Landmark. Today we're going to have a recap of the money laundering regulations and look at the guidance provided by HMRC. So we'll do a quick overview of the risks posed by money laundering to your business and how you might identify these risks. And then we'll look at what HMRC advise and then look at 3 common areas of non-compliance, such as your risk assessments, dealing with foreign nationals and identifying beneficial owners. And hopefully I'll give you a good sort of steer on this. But if you do have any questions, my contact details will be at the very end of this, so you can get in touch with us directly. Okay, so let's get started. So the first place I want to start is just to revisit the reasoning behind the compliance activity that agents undertake in relation to the money laundering regulations. HMRC, who regulate the AML compliance for estate agents, have released guidance which outlines their expectations. Now, although there is an acknowledgement from HMRC that estate agents don't handle any of the funds used to buy property, you are, in HMRC's words, a key facilitator in a property sale and come into contact with both parties to the transaction at an early stage, and so are in an ideal position to identify suspicious activity. The intended aim of the regulations is to prevent the use of illegally obtained funds or terrorist financing from being legitimised through the sale and purchase of property. There is somewhere in the region of £100 billion laundered through the UK every year, so it's quite a scary amount. In the National Risk Assessment of Money Laundering and Terrorist Financing of 2017, the report published by the government stated that 27% of money laundering cases involved property transactions, highlighted the presence of companies and trusts. 36% of these highlighted attempted use of professional intermediaries, and 17% reported high cash payments. And the recurring themes identified from suspicious activity reports, or SARS as more commonly known, were unusual transactions relating to the same property in rapid succession, often involving the use of cash or third-party intermediaries, and the use of companies or overseas trusts to conceal property ownership. And this scrutiny isn't going away anytime soon. Regulated entities, including estate agents, are required to submit a suspicious activity report where there is any suspicion of money laundering. In its 2018 annual report, the National Crime Agency, who are responsible for policing the UK's anti-money laundering regime, reported that of 463,938 suspicious activity reports that were submitted from April 2017 to March 2018, only 710 of those were from estate agents. And it's still less than 1% even if you include solicitors. Against the context of around 1.2 million transactions in the same period, you can see why HMRC are placing such a focus on property. You might have come across the government's latest AML awareness initiative, which is the Flag It Up campaign, and this highlights the legal and moral responsibility that those in the front line of the UK property market have to be vigilant to money laundering. HMRC are clear that the best way to do this is to better understand the transaction and the individuals involved, which is also known as Know Your Customer, or KYC for short. In 99% of cases, this is likely to be self-evident, with people relocating, upsizing, downsizing and so on. But you need to be vigilant where there is ambiguity over the purpose of the transaction. Now, common areas of non-compliance. So the first area of non-compliance we're going to focus on today is this implementing your AML risk assessment and demonstrating to HMRC that you are taking a risk-based approach to money laundering risk in your business. Looking at how you arrive the decision to identify an individual or transaction as low, medium or high risk. And this is where your AML risk assessment comes in. This is a critical document outlining the steps your own business takes to better understand the individuals involved and the nature of the transaction in order to make any assessment about any risk. HMRC expect you to be able to present your risk assessment to them upon inspection. HMRC's guidance suggests your risk assessment should be reflective of your customer demographic, the type of stock, the services you supply, such as property finance services, auction sales, financing methods, and your business geographic. Your risk assessment should demonstrate a risk-based approach, balancing the cost to your business and customers with a realistic assessment of the risk that criminals may exploit the business for money laundering and terrorist financing, allowing you to focus your efforts on the most important areas, and it should reduce unnecessary burdens. For example, a London agent may take a stricter approach than an agent in a provincial market town. But be aware of hidden risks. For example, a client of ours in the Lake District was inspected because of the number of high-value second homes in the area, which are often cash purchases. There are no hard and fast rules to taking a risk-based approach. It's about understanding your customers and your transactions better. Here is a list of characteristics that could point to a higher risk of money laundering, but this list is not definitive. It is important that staff are trained to be on the lookout for these sorts of characteristics and flag it with your money laundering reporting officer when there is any suspicion. And if you would like a copy of this document, please let us know and we can send it on to you. On a practical level, it might be useful to think about your risk assessment in similar terms to your health and safety assessments. You can assess a risk to the business, consider ways to mitigate the likelihood of it happening again, and put control measures in place to protect your business. You should include what steps you and your staff take to decide on what level of risk is posed, and this will differ for vendors and purchasers, but broadly, you might consider whether you've met the client, are they a UK national, do they reside in the UK, is the transaction high value or is there significant cash involved, is the transaction being conducted via a third party, or is the individual a politically exposed person, and what level of ID are they able to provide. By looking at these and then assessing how these might affect the risk profile of your client and or transaction, you can help them to demonstrate this risk-based approach. Here is an example risk assessment, scoring each of the criteria outlined and applying a level risk to the total score. So if the risk score is under a certain threshold and the client is low risk, but then if it's above that threshold, then it's high risk. So importantly, the assessment goes on to outline what steps should be taken to conduct customer due diligence on low-level risk clients, and what additional steps should be undertaken where a higher risk is identified to complete enhanced due diligence. At all times, it's important to remember that your objective is to prevent illegal funds from being legitimised through a property transaction. Taking a risk-based approach gives you the flexibility to take into account the commercial realities to selling property. So if, for example, your client is unable to provide photo ID, but sufficiently satisfies the requirement to evidence a private individual's name, their date of birth and residential address, then there's no need to be dogmatic about providing photo ID and delaying the transaction. Similarly, if you're using electronic ID, you don't need a pass in all cases. You may identify in your risk assessment where checks do not pass, but you obtain additional paper evidence and file that alongside the electronic check, then you wouldn't really need to redo a check, potentially spending more money. Your risk assessment should also take into account your process for dealing with foreign nationals and non-UK residents. Statistics from the recent Property Mark National Conference laid bare the risk to estate agents. 91,428 land titles are held by overseas companies. 170 billion worth of property is held by 30,000 companies or trusts based in tax havens. Foreign nationals and non-UK residents fall into two broad categories, those who are resident in the UK and those who aren't. Typically, due diligence on foreign nationals resident in the UK is broadly similar to UK nationals living in the UK. For example, an Eastern European family settling in the UK. In such cases, it is likely that customer due diligence can be applied. This is unless other factors in the transaction arouse suspicion. Where a higher risk is identified, for example, significant cash payments or unusually large or complex transactions, or even properties bought through multiple companies to hide assets, in such cases, your risk assessments should identify that enhanced due diligence is undertaken. According to HMRC, typical measures that can be applied over and above those applied under CDD include obtain additional information or evidence to establish the identity, take additional measures to verify the original documents supplied. You could ensure that the first payment is made through a bank account in the name of the seller or the buyer. You could take more steps to understand the history, the ownership, and the financial situation of the parties to the transaction. Or in the case of a politically exposed person, you could establish the source of wealth and the source of funds. And you could carry out more scrutiny on the business relationship and satisfy yourself that it's consistent with the stated purpose. Where you encounter an overseas vendor or purchaser or have an existing overseas landlord who decides to sell their property, this is where things can get trickier. HMRC outline that you should be able to obtain the same types of documents for non-UK residents as UK residents. Your risk assessments will identify the risk, whether it's a low or medium risk client is identified, that customer due diligence can be applied. And typical examples of this are where you're having an existing client you've met and you have a pre-existing relationship, you can cite that in your risk assessment. As long as you have a record of the due diligence when your relationship started and nothing else has changed. It is likely your client risk will be low or normal risk and you can complete customer due diligence in line with your procedures. Or another example would be a member of the non-resident landlord scheme. This is someone who owns a rental property but spends more than 6 months of the year living outside the UK. Now, under that scheme, a landlord can have a UK tax residence but the usual place of abode in another country. Non-resident landlords are registered with HMRC, which may be used to evidence a lower risk when it comes to applying due diligence. Where a new client is resident overseas and cannot be seen face-to-face, enhanced due diligence must be undertaken. How this differs from your standard customer due diligence should be outlined in your risk assessment and AML policy. For clients who do not live in the UK, HMRC advise that you should obtain the same types of identity documents for non-UK residents as for UK residents, and that if you have any concerns that an identity document might not be genuine, contact the relevant embassy or consulate or use the link to Prada. If documents are in a foreign language, you must satisfy yourself that they do in fact provide evidence of the seller or buyer's identity. HMRC may require official translations when inspecting your customer due diligence records. And typically, enhanced due diligence, it will involve verifying the identity of the individual you're dealing with, verifying an accompanying photo ID document, and this may involve the client providing their identity documents to a recognised independent professional, such as a bank or financial institution, a lawyer or notary for authentication, but they must forward the authentication statement and copies of the ID document on to you. Or you could verify the validity of the document electronically. It may be your policy to implement additional checks, such as confirming ownership details of the property with Land Registry. You could take steps to verify the source of funds. You could also ensure any payments are made through a bank account with the same name as the seller or purchaser. Now, this list is not exhaustive, but it is indicative of steps that can be taken. As with all compliance activity, it is important to establish a process. Have your staff trained and evidence your activity. The final common area for non-compliance for estate agents today is identifying beneficial owners. Customer due diligence requires you to take a rounded approach to the transaction and really understand your customer and their motivations. So this is known as KYC. When it comes to customer due diligence, you need to be identifying any beneficiaries to the transaction, otherwise known as beneficial owners. In a standard transaction, you need to ensure you are confirming who owns the property for sale. In most cases, this is reasonably straightforward, and it's going to be the vendor or vendors. There may be instances, however, where you feel the need to undertake your own verification, where the nature of the transaction poses a higher risk. You may, for example, choose to undertake your own verification in cases where you're selling on behalf of a landlord, with a higher risk being posed by an absent landlord. Divorce and distress sales may pose a higher risk, along with properties which have been changed hands a number of times in a short space of time. Now, these are just examples of your own experience, and risk assessments will inform your decisions to undertake additional verification. So how do we check the owners of a property? Now, fortunately, in England and Wales, this is reasonably straightforward. Most property in England and Wales is registered with Land Registry. You can use the title held by Land Registry to verify the information you've been provided, which corresponds to the information held on the title. The title is split into three sections, A, B and C. The proprietorship information is held in section B and will identify the owner or owners of the property. You must complete your customer due diligence on all owners of the property. This information is available in Scotland and Northern Ireland, and if you would like more information about how to get hold of it, again, please contact us. The title also holds information about the property that might be considered material information in the context of the Consumer Protection Regulations. Section A contains a description of the property and whether it is freehold or leasehold. It will refer to a plan, and a copy can be obtained from the Land Registry. If the property is leasehold, brief details of the lease, like the date or term or original parties, will also be shown in this section. A copy of the lease can again be obtained from the Land Registry. If applicable, Section A will also detail any rights, agreements or matters benefiting the property, such as rights of way or a declaration about the boundaries. These might be set out in full or by reference to an early title document. If the latter, a copy is usually filed at the Land Registry and can be requested. Although it's not expected of agents to further investigate any rights or restrictions, you may wish to ask your vendor for further clarification or advise buyers to inquire with their solicitor so as to ensure nothing comes out of the woodwork maybe 4, 6, 8 weeks down the line that causes the transaction to fall through. By taking a proactive approach to compliance, not only do you demonstrate you have considered beneficial owners, you can also evidence to prospective purchasers any issues with the covenants or the restrictions or any rights of way over the property and that kind of thing. This also improves the quality of viewings, it reduces your fall-throughs and ultimately helps to deliver the best customer journey. Some transactions may involve the sale or purchase of property by a company, for example when selling commercial property, new build or a letting portfolio. In such cases, you are required to identify the beneficial owners of the business and carry out customer due diligence. A beneficial owner is anyone who has 25% or more of the shares or voting rights. As these stats show, land held by corporate and commercial bodies is not insignificant, and establishing ownership information can present challenges. As discussed, there is within the 5th Money Laundering Directive the intention to provide greater transparency of ownership. At the moment, there are a couple of ways to establish ownership information. The 4th Money Laundering Directive introduced the Persons of Significant Control Register, and this is available by Companies House. However, some of this data is still incomplete, and where subsidiaries hold over 25% of the shares, more investigation is needed. We're going to look at an example of how to establish beneficial owners. A beneficial owner is an individual who has a 25% or more controlling stake in the business. Be aware you may have more than one beneficial owner. In some more complicated corporate structures, the beneficial owner may be identified through holding companies, depending on the ownership status of the company you're acting on behalf of. In this example, an agent is instructed by company Y to sell a portfolio of properties. Looking at the ownership structure here, we can see that Mr. A owns 25%, Mr. B owns 25%, Mr. C owns 30% of the company. Now he owns 60% of C&D Limited, which in turn owns 50% of company Y. And Mr. D owns 20% of company Y. So where we have anyone with 25% or more of the shares, we need to apply customer due diligence. So in this case, we need to apply it to Mr. A, Mr. B and Mr. C, because they are all over 25%. Where you are acting on behalf of a large corporate or public body, for example, a large house builder, a bank or law firm or charity, a beneficial owner is anyone who owns or controls over 25% of the shares or voting rights, or they ultimately own or control, whether directly or indirectly, including bearer shares, holdings or other means, more than 25% of voting rights. That they exercise ultimate control over the management, or they control the corporate body. The reality is, in a lot of cases, this is just going to be difficult to obtain and even more difficult to conduct customer due diligence. I mean, let's take the example of the sale of a repossession property by a bank. In such cases, you may, provided you've outlined it in your AML policy and risk assessment, you could just apply simplified due diligence. Banks are themselves regulated entities under the anti-money laundering regime and will therefore have their own risk policies and procedures in place. Unless anything else in the transaction arouses suspicion, as I said, you could apply simplified due diligence. This will involve obtaining evidence of their existence from company's house, for example, or retaining records of your correspondence, like any emails or letters you've had from them. And the same could be applied if you're dealing with a listed house builder as well. You may come across cases where you are selling on behalf of a trust or a probate matter. For trusts, the beneficial owner is the settlor, the trustees, the beneficiaries, or the individuals who benefit from the trust and in whose main interest the trust is set up, and or individuals who exercise control over the trust. In probate cases, you're often dealing with solicitors. In addition to any beneficial owners, you can apply simplified due diligence for the solicitor unless you identify a greater risk. In which case, you can verify the solicitor using the Solicitors Regulation Authority website. And in the case of conveyances, you can use the Council of Licensed Conveyancers website. The solution to all of this would be Landmark, providing a range of electronic solutions to help estate agents demonstrate compliance with the money laundering regulations. Under the Compliance in a Box brand, we provide interpreted electronic AML checks to help agents verify their customers in under 60 seconds. From one online portal, we also enable agents to identify beneficial owners with direct access to the land registry title information. We also provide company checks which outline the ownership status of the business. As discussed, dealing with foreign nationals and those not resident in the UK presents a challenge to agents and can be a more manual process, but our electronic foreign national checks help you to fulfill your enhanced due diligence. Once you've established the initial checks on your foreign client, you can use the foreign national check to electronically verify the documentation that you've been provided is not fraudulent. Using electronic data is more thorough than using paper methodologies and provides a better experience for your staff and clients. Instead of requesting paper ID from purchasers and potentially slowing the transaction, how much more positive an experience are you providing your client with electronic checks? Yes, there is a cost associated with some of these, but what is the sunken cost to your business of staff spending time chasing answers to this information and storing it? What is the perception that this leaves your customers too of your business? What is the cost of an electronic check compared to the potential listing you could win by redeploying staff time to a more proactive business activities? Our service is pay-as-you-go with no contracts, setup fees or tie-ins. Thank you very much for your attention today. I hope you have found this useful. My colleague's details are here on the slide for you. That's for Simon. If you do have any questions, please don't hesitate to get in touch with us. Thank you very much, everyone.